Yeah, so I think that if you looked at Ben Graham and all of what he was talking about, he relied on hard asset downside protection, right? And part of the reason he relied on hard asset downside protection is because he came out of all the turmoil of the Great Depression and all that, the 1930s with the stock prices and doing what they were doing. And he saw all the decimation of wealth that took place at that time, right? And so, in many ways, you could say that Ben was scarred from that experience. And so, the what came out, security analysis that came out from that experience was very much, we are going to invest in a manner where no matter what happens, we cannot lose money. Okay. The problem with that approach is it also crimps your upside. So if you buy some crappy business that is trading at one third of liquidation value, probably it doesn't have much upside either. That's the nature of the beast, right? And so Warren actually evolved from there, and the big evolution for them came when they saw what happened with Seas Candy, right? And so the Seas Candy experience, because he paid more than $25 million for a book value of less than 5 million, right? He was paying several times book value, which to him was a big step in a different direction. But the Seas investment led them to make the Coca-Cola investment. And when they made the Coca-Cola investment, again, it was the same thing. The downside protection was not hard assets. The downside protection was the brand and all the embedded memories we all have of Coke deep in our psyche. So even when he made the investment in Apple, the downside was not in the hard assets. It was in the brand value and what link customers had to that company. So I think and the other thing is something Munger pointed out is that Ben Graham always focused on all these net nets and downside protection. He made all his money on Geico. And Geico, he made money on Geico not because he bought it cheap. He made money because it was a great business. And so when we look at margin of safety, I think we have to be a little more flexible because typically you're not going to get all of the above. You're not going to get heavy downside protection in terms of hard assets, where even in worst case times you'll come out ahead and at the same time have 100 bagger potential. So the two generally will not go hand in hand. It may happen once in a while, but it will typically not happen all the time. And so I think we need to look at downside protection. We need to be comfortable that the downside may not be protected purely with hard assets. And we may even go to the point of saying that if things don't work out, we may have a problem, but the odds of that are really low. So when you look at businesses like, you look at Copart or any of these other kinds of businesses, you can't really get to downside protected with hard assets. But a combination of the culture, the values, what the reputation means in customers' minds, the links with the insurance companies and the links with their all the other ecosystem, that's what's giving you the protection. And so you need to get comfortable with that.
The modern day margin of safety, as explained by Mohnish Pabrai, is completely different from what Benjamin Graham originally meant. Even Warren Buffett evolved from Graham's idea, but it was Charlie Munger who truly understood this modern version way back in 1960s. Back then, investors focused on tangible assets, factories, land, inventory, to determine how safe a business was. If a company went bankrupt, those physical assets could be sold to recover investments. But today, that's not where real safety lies. Now, your margin of safety comes from intangible strengths: brand power, competitive advantage, loyal customers, and a strong business moat. So here's a question. Go back and look at your portfolio. Do the companies you own have modern day margin of safety? If not, maybe it's time to rethink what truly makes an investment safe.